All righty, welcome to week 2, class. Based off the grades, it does look like most everybody's following along. Remember, if you need help catching up, we do have the Zoom meetings on Wednesdays at 4 p.m. I'll put out the meeting invite and the announcements. Little housekeeping before we get into the problems. So remember, if you go to course content, model week 2, this week you'll be reading chapters 3. You have the presentations, videos here. And then if you go to the learning activities and assessments, have another discussion board. So remember, on the discussion boards, you need to make your post by Thursday night and then have 2 replies by Sunday night. And the rubric of it is right here. And then you have your chapter 3 Learn Smart, and then we'll get into the homework assignments. So for the discussion board tonight, your conversation is going to be around whether or not a company should move from the accrual to the cash base, or which one's the most appropriate. So I want to make sure that y'all understand the difference between the cash and the accrual. So cash base, everything's going to be recorded when the cash actually trades hands. So when the services are paid for, or when the invoice is actioned. The accrual-based accounting, it's going to be based off of when something actually occurs. So the first thing, you need to make sure you know what basis we're talking about, and that's going to determine when, not so much how, but when the transaction is actually recorded. And so when we're talking about when, I wanted to look through the accounting cycle. So should have some type of graph like this in your textbook, walking through this based off of where you are as an accountant in your career, or kind of what you're using this for. You might be in different parts of this cycle, or if you're looking, those who are into marketing or kind of just using this to help build out your business side of things, you're going to be in step 7, preparing the financial statements and seeing these. A lot of the accountants, the month-end accountants, we're going to be dealing in step 5, and today's homework is going to be on step 5, making the adjustments. But I wanted to make sure you can walk through this and understand what exactly is happening. So step 1, to begin, something has to occur. You have to have some type of economic transaction, a trading of services or goods, something expiring, something has to incur. Otherwise, there's nothing for us to record. But once that occurs, our job is to look in and see what accounts does it impact. Is it increasing or decreasing? How does that impact the debits or credits? Our job is to go in there and make the journals. Once the journals, we need to post that into the T accounts, go through and actually calculate what the ending balances are, and then that'll get us a preliminary trial balance. With the preliminary trial balance, our job is to go through there and look and see what has changed since we initially recorded it to now it's month end, and we need to make some type of adjustment. So we want to see what the numbers are first, make the adjustments, and then get a final adjusted trial balance. Once we have this, we can then take those numbers and directly put them into our financial statements. So that's your balance sheet, your income statement, cash flows, everything comes off of the trial balance. Once we're done for the month and the reports are issued, we'll close out and get ready to start again with the fresh trial balance. And then the transactions start rolling in again and we start all over. All right, so with that in mind, we'll go into our homework. So again, homework assignment 2. And again, this homework assignment is on step 5, figuring out what has happened since when we initially recorded the transaction to today. So we're going to go through various examples of what might have changed during that time. All right. So today you have 12 questions. And the first one, we're talking about office supplies. So office supplies is, again, the transaction that occurred is we purchased office supplies. We're not going to make a journal entry each and every time someone goes to the supply closet and get a pen or a piece of paper. We're just going, because at that point, it's just too minute. But when you get to the end, we have to figure out, well, how much office supplies do we still have at the end of the day? And then from there, we need to adjust that balance down. Okay. So a lot of y'all noticed that y'all are a little bit worried about math in this class and you wanted to get a little bit stronger. Always have Excel open. I will never ask you to do any problem that Excel cannot solve. But as we go through this, all right, so we started with 2675. We purchased 11048. And when we did an actual supply count at the end of the month, we found out we had 2, 3, 5, 4 left. So the question is, how much did we use? So we're going to use just a little bit of algebra, add those two together, subtract that one, and we know that we had to have used that much. And so office supplies is the asset. Office supplies expense is obviously the expense account. So to increase the expense, we debit it. To decrease the asset because we used it, we credit it. So again, we're not talking about the transaction of when we purchased the supplies. We're talking about each time someone got a pen or a piece of paper or any of the supplies, what do we have at the end of the day? Okay. Insurance is another good example because at the beginning, we'll always prepay insurance. So think about your car insurance or your house insurance or anything like that. You usually pay either at the beginning of the month or 6 months or up to a year. The insurance covers you for that entire period. So we're not going to expense it all at once because you still have the use, the economic use of that insurance. If something happens 23 months into this coverage, you receive that benefit, okay? So because of that, we're going to prorate it each month, what the cost is, and every month adjust to decrease the insurance prepaid and increase our expense. All right, so we have 3 policies here. Try to keep these straight. One for 11256, 10080. Next, for 24, 36, and 12 months. So the first thing to do is just calculate what your per month cost is. And then let's see where we're at. So they paid at the purchase date, and today is now December 31st. So we have a full 12 months on that one. Wait, no, because that one would have expired in April 2017. So you only have from January 1 to April, January, February, March, April, that's 4 months. The second policy does go through the entire year. And the third one, we only have it from August 1st to December 31st. So August, September, October, November, December. You're going to multiply those across. And you're going to sum up. 4, 7. Yeah, it is important to know your months. So 3 months is there. Is it in April 1st? So you only go through March. All right. The company has 15 employees who earn a total of $1,600 each working day. They paid each Monday for their work on the previous Friday. So we're here on a Tuesday. So that means they were already paid for last week, but we need to recognize the Monday and Tuesday worth of work. Okay, so that's just 1,600 times 2. And again, you're increasing your expense, increasing your liability, because we have not paid these employees, but if the company was to end on December 31st, we still would owe them their last paycheck. All right, that's always something to be thinking about. What we ended today, what would happen? Next one, company purchased a building, cost $680,000. All right, so this is on your depreciation. So we start with $680,000 in costs. We have a salvage value of $45,000. And a 25-year useful life. And it was purchased on January 1st, and it's now December, so we have a full year. So annual depreciation, they actually tell you that, it's $25,400. We're going to increase our depreciation expense, and we're going to increase the accumulated depreciation. So remember, each time you see an account, we need to be making our flashcards. Accumulated depreciation is what we call the contra asset. So it's on the asset side of things, but it's contra, so it's going to be the exact opposite. So instead, a credit is going to increase this, and this is going to still decrease the net value of that building. Okay. The company is not large enough to occupy the entire building. We also rent a space. They have not paid the December rent. So we now have a rent receivable, and we earned the December because we let them use that space. So we have a receivable that's increasing, that's an asset, and almost revenue is rent earned increases a credit. All right, we also rented another space for this much. They paid 5 months in advance on that. And so now when we did the advance, we would have debited cash and credited our liability of unearned rent. Now we've earned that rent, so we're going to decrease that liability by debiting it and crediting our rent earned again for the 2 months of November and December. So you do 2265 times 2. We got to realize the fact that it's no longer unearned. Okay. Then we go into question 2. All right, so we recorded prepayments and asset accounts and cash receipts of unearned and liabilities, and we're making adjusting entries now. So the question is, when we go to adjust for wage expense, which one's going to be the debit and which one's going to be the credit? So wage, the expense, the way to increase an expense is debiting it, and it's increasing our liability. To increase the liability, you credit it. So the account's wage expense and wage payable. For accrued utilities, again, we want to increase our expense, so that's the debit. And the utilities, we're going to usually pay that out of our accounts payable. And the difference between wages payable and accounts payable is just who it goes to. So wages is internal, it goes to our employees. Accounts payable is external, it goes to our vendors. And then we record salaries expense incurred for paid in advance. So if it was paid in advance, we're still increasing the salary expense because they now earn that salary, and we're decreasing the prepaid. So decrease an asset, credit to it. All right, again, repetition until it's memorable. We're doing wage adjustments. So again, we're going to debit the wage expense to increase the expense, credit the liability to increase the liability. We're going to do it $95 per day. They're paid on Fridays for work completing up to that Friday. And here we are on January 4th. Oh, wait, first we need to do just the, yes, just the Monday. So 5 workers, $95 a day, just one day is $475. And then when we actually pay it out, so that's when cash is decreasing because we're paying this out to the employees. So we're going to credit our cash. We have to recognize the 4 days between Tuesday and Friday when we're actually making the payment. So 4 times 95 times 5 gets you to the 425. Yes, because New Year's was unpaid holidays, so you're only going to be working for 3 days that day. And then we're paying out the payable, so at that point, our liability is decreasing. We're going to debit it. All right, so we started out with 17,100 in premium for a 36-month insurance policy. So here they want you to compare the cash basis versus the accrual basis. So the cash basis, we're going to record all of it to an expense the moment we actually make that payment. So that's on in 2015, we take the entire cash into the insurance expense. We never use prepaid because prepaid is for an accrual. Okay. If we are using the accrual, we start with 17,100. And it's a 36-month policy. So again, our monthly expense is $475. From March 1st to December 31st is a full 10 months. So the expense side of it is going to be 475 times 10. The expense for that year is 4,750. And therefore the prepaid balance is going to be the difference there. It's 12,350. Then in 2016, we have a full year, so it's going to be that 475 times 12. So your expense is going to be 5,700, and your prepaid is going to drop to 6,650. We have another full year in 2017. We carry those down, and then in the last year, we expense the remaining amounts. Okay. That walks through the math. More repetition. So we have wage expense. We're going to increase our wages, debit, increase our liability, credit for the 11,000. They tell you depreciation is 11,800. Increase our expense, increase our contra asset. Supplies expense. So they tell you we started out with 370. We purchased 6,250. And when we counted it, we only had 675. So again, our adjustment is going to be the sum of those two minus that, 5,945. Okay. Insurance expense. So we started with 5,000. And we only have 1,600 left. That means we need to reduce it by 3,400. Again, to increase insurance expense, we debit. To decrease the asset, we credit. And then we earned 550 of interest. So interest receivable is an asset that's going to go up. We debit it. Interest revenue is the revenue account. We're going to increase it to credit. Because it says we're not going to receive that interest until January 10th. And then we have a bank loan that we incurred the expense. So we're going to increase our expense, debit, interest expense. and we're going to pay that interest on January 2nd. So as of December 31st, we have a liability. Increase that liability, credit. All right, so here they just want you to make sure that you understand the algebra completely. So again, we'll walk through this. So you take the beginning value plus additions minus usage gets you ending. Okay. So in the first one, we have the beginning, we have the additions. We're trying to find which one is the current. So they want you to say total supplies available is just the sum of those. Then less supplies at current year, the ending. So your usage is the difference between that. Supplies at the beginning, we added that, so the available will be that. Here they tell you, so it's 60. 3904 is in the middle. Here, supplies there. They don't tell you that one, but they tell you that the total available is that amount. So we're just going to take that minus that. And then, again, at the end of the year, it was 1381. So the amount used is 5624. Here they tell you you purchased 4204. You had available 5579. So that means at the beginning you had 1375. You have 800, and you use 4779. All right, you can see the calculations there. And repetition. So we're matching these up. So to record depreciation, we're looking for the one that has depreciation. And again, we just want to check it, increase the expense, increase the contra asset, credit, yep, A. Salaries expense, we're looking for salaries expense, increase the salaries expense, increase the liability, yep. Prepaid expense, so we're looking for prepaid expense. Prepaid insurance, okay, so increasing the expense, decreasing the insurance, let's see. Interest revenue, right here, increase the receivable, increase the revenue. Interest expense, debit, increase the expense, credit the payable. And unearned income, we're now earning it, so we want to decrease the liability, debit it, credit the revenue. Okay. All right, so again, we're just going to walk through that same. So the text tells you that the beginning balance is 5,800. That's the beginning of the prepay. That's a debit. It tells you that we ended with 1450 is what we need to have. That's also going to be a debit at the end. So how do we get from a debit of 5,800 to a debit of 1450? We credit at 4350. So there's your debit and credit amounts. We need to increase the expense, decrease the prepaid. All right, and if that was 6990, And we said that 1480 of it expired. So we start with a debit, we expire it with a credit. That's our debit and credit. So we're ending with 5510. Then we're going to increase the expense, credit the insurance, prepaid. We here started with 37,200, and that was on September 1st. We now need to calculate that from September 1st to 12/30. So it's going to be for 4 months. So we're going to do that math at 6,200. And if we credit at 6,200, then our ending balance is 31. Increase the rent, decrease the prepaid. Okay. All right, here we're again comparing the cash between the accrual. So if we earned 54,000, but we only received 46 in cash, then under the cash basis, our revenue was only 46, but under the accrual, it was the full 54. And here we incurred expenses of 30,000. Again, we only paid 23,400, but at the same time, we paid 9,000 for costs on the prepaid. Okay, so from a cash basis, we're only going to take the 23,400 and the 9,000, add those together, you get 32,400. Net income is revenue minus its expenses. So our cash base is 13,600. Under accrual, it's the 54,000 that we earned minus the 30 that we incurred. We're at 24. And here you just need to know the definitions of each of these. So if we have 12 consecutive months that end on December 31st, very specific, has to end on December 31st, that's noted as the calendar year. Not all businesses use the calendar year for reporting their accounting cycle. A lot of those try to trail off. So my company, we prepare financial statements every June 30th. So for that, our fiscal year is still 12 consecutive months, but the fiscal year is going to end on June 30th for us. And a natural business year may be used by companies who experience seasonal varieties in sales. So what that means is that the seasonal variations is that some businesses do better in winter than in summer. Think of a ski resort. Some places do better in the summer. Think of a beach or something like that. So because of that, we really try to do an entire year's worth of comparison. So the natural business units there. Financial reports covering a one-year period, we call that annual financial statements. And again, that clears out that seasonal variation. So if your summers are better than your winters, well, we're looking at the year total. So each year should be comparable to the last year, hopefully. All right, and then it does build on the assumption that each period of time can be divided, and we can look at something specific. So looking at 1 year or 1 month, it's just that you have that assumption, that otherwise there's no point in stopping it. All right, identifying again, matching up one to the other. So unearned revenue, we're looking for the unearned revenue. So receipts of unearned revenue, which will be the receipt is when we receive cash and then we credit the liability. And then once we earn it, we decrease the liability by debiting it, and then we're able to credit the revenue there after earning it. To record payment of an accrued expense, so payment, cash is leaving the door, we're looking for a credit of cash, and we're looking for a decrease in the liability. So that's going to be the salaries payable there. Decrease cash, decrease liability. To record receipts of an accrued revenue. So this time we accrued it. And now we have the cash. So the cash comes in the door, that's increasing the asset. And then when we accrued the revenue, we noted an accounts receivable was there. Now we're removing that accounts receivable by crediting it. To record the accrued expense, so we're going to increase interest, increase the liability. To record accrued revenue, increase the AR, the receivable, asset, increase the revenue, credit. Use of prepaid expense, so we're going to be increasing an expense and we're going to be decreasing an asset. So we're looking to decrease an asset, prepaid rent, increase the expense, debit. Record payment of a prepaid expense, so cash is leaving the door and we're getting a prepaid asset in return, a prepaid rent, credit cash. And depreciation, again, we're going to increase depreciation expense and we're going to credit the contra asset, increasing the contra asset of accumulated depreciation. All right, final question. Classify the expense as either prepaid, unearned, accrued revenues, or expenses. So service revenue, we know we're going to be dealing with revenue. Performed but not yet billed. So that's when we call accrued, because we performed it, we earned it, but we haven't billed it yet. So that means that we haven't received cash. So we're going to still accrue that revenue. To record supplies used as supplies expense. So again, we're dealing with that prepaid, is that we paid for those supplies up front and now we're using it. So the expiration of prepaid goes in the same category. And record cash received from a customer for which services have not yet. So we have not yet provided it, meaning we didn't earn that cash yet. The liability. And to record office salaries expense incurred but not yet paid is the accrued expenses, because we incurred that expense, so we have to accrue it because we haven't sent the cash out yet. All right, so that's your homework for this week. And again, if you have any questions, I'll see you all Wednesday at 4. And I hope you have a great week.